Hello and welcome again to Rob Cuts Tax. Today I'm going to be sharing how I use a unique strategy to pay far less tax and build a vastly bigger investment portfolio than what would otherwise be possible through the conventional approach. Now, the standard disclaimer applies here today. I'm not a financial advisor. This is not financial advice. I'm just going to be talking through my strategy, what I do. So please go away and do your own research prior to any investing. So let's recap where we left off in the last video. My strategy uses cheap and safe borrowing to front load my self-invested personal pension with a large lump sum. I then benefit from basic rate tax relief within the account and then higher rate tax relief after submitting a tax return online. The debt is minimal and it's paid off within 5 years. The wealth, however, remains and compounds, securing me with a great pension for the future. If you're confused, don't worry. We're about to break this down into bite-sized chunks. So the first thing that I need to work out is how much I need to borrow in this financial year. So around February to March each year, I look at my payslip and check my total taxable pay, and from there I make an estimate as to how much I will be above the higher rate threshold come April the 5th of that year. So using an example of me earning £60,270 of taxable income, I would be liable to pay taxes on the top £10,000 at the higher rate, which would equate to about £4,000. Now I know that, I know I need to borrow £10,000 to go forward with this strategy. So now I know I need to borrow £10,000. I evaluate my options with my chosen provider. In this case, it's coming from a sub-account on my mortgage, but for argument's sake, I could also take out a loan. The key for me here is the time period, repayment and interest rates. I think 5 years is a good period for me, and I want the lowest possible fixed rate. I would never choose a tracker or variable rate, as this adds risk, which I'm not willing to take on. The repayments are within my means and I can comfortably service this debt going forward. In the example here, I've shown the average 5-year fixed rate in the UK at the time of recording, which is 4.95%. The total cost in interest of this loan is £1,309. This is an important number to remember. We need our basic rate relief to comfortably beat this number for the strategy to remain viable. As we'll receive £2,500 of basic rate relief here, this is a green light for me. So now that I have the loan, I have to ensure it's put into my SIPP within the same tax year to qualify for higher rates of relief. As soon as the £10,000 lands in my account, I can invest it into the market. I immediately qualify for basic rate release at source, which means I will receive £2,500 within my SIPP from HMRC. So I'm already making a gain that's larger than the interest on the loan. So, as I just touched on, the tax relief is what makes this strategy so powerful, and it's about to get better because I'm a higher rate earner. At the end of the tax year, I complete a self-assessment online through the HMRC website. It's actually really simple and it takes me less than 20 minutes to complete. I can then claim back a further 20% tax back as higher rate relief. My total tax relief so far is now £4,500. My higher rate tax bill has evaporated and I'm sat on a SIPP with £12,500 worth of funds I can invest. For a bonus, I can invest that £2,000 higher rate relief I received back into my SIPP and gain a further £500 of basic rate relief for a SIPP that would then be valued at £15,000. After 5 years, the original loan will have been paid off in full, but my pension pot will remain. And if it's grown at a conservative rate of 7% a year, I could have turned a tax bill of £4,000, that's a loss of £4,000, into a gain of more than £17,500 of wealth that I can use to retire on in the future. After 20 years of compounding with no additional contributions, I could be looking at a SIPP with just shy of £50,000 inside of it, all built with a loan that cost just £1,309 in interest. That's roughly 37 times the cost of that loan. And it doesn't even include the eliminated £4,000 of higher rate tax that we've avoided. What's best is it's completely legal. But here's where it gets even better. I plan on doing this every single year until I retire, as long as it meets my requirements built in to safeguard me, namely low interest loans and fixed payments that I can afford. I'd like to say thanks for watching. In my next video, I'll be looking at comparing this strategy with a more conventional approach. So feel free to subscribe if you want to see more videos like this. I'll also be sharing another innovative strategy that may be of interest to dividend investors in the very near future. I also want to apologise for and explain the poor sound quality. I may sound a bit nasally at the moment, and it's due to hay fever here in the UK. As for the background noise you may have heard, I live in quite a busy urban area, so I'm still figuring out how best to manage that. Please comment with any constructive criticism or questions. I really do want to hear from you, so thanks again.